Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
We've got the CPI in, as you can see. It is lower than expected on this December print, and not by a lot, but enough for the market gods to say, okay, this is good, but that's not why we're bouncing. There are 3 reasons why we're bouncing. But first of all, let's go over CPI. It was a little bit less, even though it's a rounding error. Nonetheless, it came in, as you can see, all the way down the line, in line, a little bit less, et cetera, et cetera. So we basically have a smidgen lower in CPI, and most folks out there are saying, yay, CPI came in weak. That means inflation is falling, which means the Fed is going to cut. And that's just the algos reacting. So what we also have that is not really kind of noted is real earnings are also falling. So we're down negative 0.1% also from last month. And the Empire State Manufacturing came out, which most don't really care about, if truth be told, but I will tell you, it is interesting because everything from the prices paid are up. 29 is the level. It's an 8-month high. 6 months ahead look for prices paid is almost 55, which is basically a 2-year high. So the Empire ISM came in very hot on prices, even though we had a little bit, and I repeat, a little bit weaker than expected core CPI print. It was 0.23% month over month versus 0.26%. And all that is rear view mirror. So it does not price in what's coming, which is higher yields and dollar and energy costs for this past month will be reflected in next month's CPI, which I talked about. Anyway, long story short, this is really where we're at. So I took this chart from Twitter where he does a really great job of saying, hey, US core CPI has been above 3% for 44 straight months, the longest period of elevated inflation in the US since the early 90s. So again, they're kind of getting, the market is reading in, or the algos are partly reading in this slight beat, but in reality, I just read off the numbers, right? Core CPI print was 0.23 month over month versus 0.26%, not a big beat. And the reality is we are still in a trend of sticky inflation. So that's why I like to not just focus on the data from 1 month, but the trend. And I think that matters a lot more. Also, what matters is consumers' ability to afford this sticky inflation, which is right here, right? They're losing ground as inflation is gaining it. So that's first and foremost a really, I think, a more important consideration. But it's interesting how we're having a bounce, and we're having a bounce of size, but I contend it is because of this. Last night, and if you look this morning, bonds are bouncing with yen, with stocks. So comments from Bank of Japan Governor Ueda basically said they are going to have a live meeting at this next BOJ rate decision, and a rate hike will be considered, which is basically later this month, which is when I said that's the time, not before November, December, because I said they're not going to hike until the Fed pauses. And my baseline bet is that the Fed would pause in January. That would allow them to hike. And you already know what's been going on with that 10-year JGB. Look at this, right? So this already told me that they are seriously considering it, because their 10-year yield has already front run this announcement to 0.125. This is where the 10-year Japanese government yield is. And this is something that came out last night. This morning, the market is gapping higher on a slight beat by CPI, which the algos are pricing in. Ooh, the Fed's able to continue their normative rate cut regime, and I say nope. So I don't think that's it. I think the Fed is still going to pause in January, and I think that the market is getting supported by the help of CPI, but also the Bank of Japan comments and something else. Yesterday, and I just saw this morning actually, the futures market, they had a 3-1 put call ratio, which means they raced in and bought a whole bunch of puts in the futures yesterday, a whole bunch, in order to hedge against strong CPI. So they came in and they hedged the futures market and bought a mess load of puts just in case, and now they're unwinding those. So you had the futures that is absolutely spiking higher on those puts. They were not selling, they were buying. There was a hedge. Big though. It skewed the data. You have Bank of Japan coming out saying they're going to have a live meeting and coming wage round, all that stuff. They're, talking up inflation, et cetera, et cetera. Okay, so moving on. That is what I think is the reason for this very exciting bounce. We've got CPI slight beat. We've got Bank of Japan hike. Odds are rising and the yen jumped. The yen jumped. So I personally believe the bonds did not care about monthly tick lower and PPI, nor should they, right? Big picture. But they will care once this 10-year, 2-year yield curve hits 45. It approached almost 43. And they will probably care about CPI next month, but I was not interested in it this month. And honestly, it's not a big beat. And bonds will really care. Really care. I left the best for last. For BOJ hiking rates if they follow through. For now, the rising 10-year yield spiking to 1.25 will start to matter to US bonds and yen. I don't have anything big picture that says bonds are done going down. This was just for a little bounce. So we have this morning bonds and yen and stocks bouncing. But I would say, again, the futures market is driving this engine for the most part. And the CPI algo machine is driving this equity bounce for the most part. And look what advanced decline today, a massive, this was bearish engulfing. This is bearish and a bullish engulfing. Complete reversal at the 50. Complete reversal at the 50. So here's your 200-day tag, your 200-day tag. And remember, this 90% up day, which is I'm going to guess, we're probably having a 90% up day, will be followed by a 90% down day. But it can take a few days. It's probably next week. It could come Friday or it could come Tuesday. But I don't think that Trump's going to want the market to fall on the day after. So maybe Friday. But the point is, we have a big 90% up day. You can bet on a 90% down day coming within a week. I just saw it. Breadth up volume plus 91% out of the gate. Knew it. I just, it's a feel. It's a feel. I don't even need the numbers anymore. 91% breadth out of the gate via Walter Demir. Love that guy. Oh my God. Look at that. Love. So cool. We get up 90%. We will also have a 90% down day. It is not a question of if, it is just when. Look at that. Walter Demir, 91.73. So that's I love studying breadth. It's, to me, you have to have consistent breadth, and that's what keeps the market in a trend. And we are out of trend. Now, I know you're all looking at individual stocks, and I'm just looking at the backdrop to say, is it safe? Well, I know it's a bounce, but it's not a rally. I still believe that.
Join Club today to engage with Samantha and her team of 10 experts. Scan this QR code or click the link in the description. Subscribe to LaDuc Trading YouTube channel for more live trading room recap videos and other content.